What if the real secret to building wealth isn't exciting, fast, or dramatic, but actually slow, predictable, and even a little boring? What if the investors who win in the long run are not the ones chasing headlines, but the ones quietly repeating simple strategies year after year? In a world that celebrates quick gains and viral success stories, boring investing may be the most underrated financial advantage you can have. Hi, I'm Max. If this video is useful and interesting for you, make sure to like and subscribe. Here, we talk about finance calmly and clearly, focusing on long-term thinking, smart habits, and financial decisions that create real stability over time. Today, we're exploring the power of boring investments, and why they often outperform exciting ones. When people hear the word investment, they often imagine rapid growth, big risks, or dramatic market moves. Social media highlights stories of individuals who made large profits from speculative assets in a short period of time. These stories are emotionally compelling, but they rarely represent the typical investor's experience. In reality, consistent, disciplined investing in simple assets, such as broad index funds, diversified portfolios, or stable dividend-paying companies, has historically produced strong long-term results. Boring investments usually share several characteristics. They are diversified, relatively low-cost, and designed for long-term growth rather than short-term excitement. For example, investing in a broad market index fund means you are not betting on one company or one trend. Instead, you are participating in the overall growth of the economy. While this approach may not produce dramatic gains overnight, it reduces risk and smooths out volatility over time. Consider a simple comparison. Investor A constantly searches for the next big opportunity. They buy trending stocks, react to market news, and frequently change their portfolio. Investor B invests consistently in a diversified index fund, adds money every month, and rarely makes emotional decisions. Over 1 or 2 years, Investor A might experience higher peaks. But over 10 or 20 years, Investor B often ends up with more stable and reliable growth. The difference is not intelligence, it's discipline and patience. Another key element behind boring investments is the power of compounding. Compounding works best when it is uninterrupted. Frequent trading, emotional reactions, and speculative behavior can break the compounding process. When you leave your investments untouched and allow them to grow steadily, returns begin to generate additional returns. Over decades, this effect becomes significant. Even moderate annual returns, when compounded consistently, can transform small monthly contributions into substantial wealth. There is also a psychological advantage to boring investing. When your strategy is simple and structured, you reduce stress and decision fatigue. Instead of constantly monitoring markets or reacting to headlines, you follow a predefined plan. This stability allows you to focus on increasing your income, improving your skills, or building additional streams of revenue. In other words, boring investments free up mental energy for more productive areas of life. Many people underestimate how powerful consistency can be. For example, investing $300 per month into a diversified portfolio with an average annual return of 7% may not feel impressive in the beginning. After 1 year, the growth seems modest. After 5 years, it becomes noticeable. After 20 years, however, the results can be life-changing. The process feels slow, but the outcome is meaningful. Excitement often attracts attention, but stability builds wealth. Boring investments may not give you stories to share at parties, but they quietly create financial security in the background. They rely on structure, patience, and time rather than prediction and luck. Understanding this shift, from chasing excitement to embracing consistency, changes the way you approach money. Instead of asking, "What's the fastest way to grow my money?" you begin asking, "What's the most reliable way to grow my money over decades?" That question alone can redefine your financial future. If boring investments are so powerful, why do so many people avoid them? The answer lies not in logic, but in human psychology. Our brains are naturally drawn to excitement, novelty, and the possibility of quick rewards. Slow progress feels almost invisible, while rapid gains feel thrilling. This is why speculative opportunities often attract more attention than steady, diversified strategies, even when the long-term probabilities clearly favor consistency. One of the biggest challenges investors face is emotional decision-making. Markets move up and down every day. News headlines amplify fear during downturns and exaggerate optimism during rallies. When someone follows a boring investment strategy, such as contributing monthly to a diversified index fund, the temptation to do something during volatility can be strong. However, constant adjustments often reduce performance rather than improve it. Imagine two investors during a market decline. Investor A panics and sells their portfolio after seeing a 15% drop. They wait for better conditions before reinvesting. Investor B continues investing consistently, even when prices are falling. Months later, when markets recover, Investor B benefits from having purchased assets at lower prices. Investor A, meanwhile, may re-enter the market at higher levels, missing part of the recovery. The difference again is not knowledge, it is emotional control. Boring investing requires accepting that volatility is normal. Markets are not straight lines, they fluctuate. Over short periods, returns can be unpredictable. Over longer periods, however, broad and diversified markets have historically trended upward. This long-term perspective allows investors to tolerate short-term discomfort without abandoning their strategy. Another reason boring investments are powerful is cost efficiency. Many exciting strategies involve frequent trading, management fees, or high transaction costs. These expenses quietly reduce returns over time. In contrast, low-cost index funds and diversified portfolios often have minimal fees. While a difference of 1 or 2% in fees may seem small annually, over decades it significantly affects total wealth accumulation. Small cost reductions compound just as returns do. There is also a structural advantage in automation. When investments are automated, for example, through monthly contributions directly from your income, you remove willpower from the equation. You don't rely on motivation or timing the market. Instead, you build a system that operates consistently regardless of your mood or market conditions. This automation transforms investing from an emotional activity into a disciplined habit. Consider a person who invests $500 each month automatically for 20 years. They do not attempt to predict market cycles. They do not chase trending sectors. They simply follow a predefined allocation. Over time, their portfolio grows steadily. Meanwhile, someone who tries to outperform the market through constant adjustments may experience periods of outperformance, but also periods of significant underperformance. The consistency of the automated investor often produces more reliable results. Boring investments also encourage a healthier financial identity. Instead of seeing yourself as a trader reacting to daily events, you begin to see yourself as a long-term owner of productive assets. This mindset shift is subtle but powerful. Owners think about decades. Traders think about days. Ownership aligns better with wealth building because businesses and economies grow gradually over time, not overnight. It's important to recognize that boring does not mean passive in life. It simply means disciplined in strategy. You can be ambitious, creative, and entrepreneurial in your career while maintaining a stable, predictable investment plan. In fact, having a boring investment foundation often gives you the confidence to take calculated risks elsewhere, knowing your long-term capital is growing steadily in the background. Ultimately, the power of boring investments comes from alignment with how markets actually work. Growth tends to be gradual, diversified, and compounded over long periods. When your strategy mirrors that structure, you increase the probability of success. It may not look dramatic from month to month, but year after year, the quiet discipline of consistency becomes a powerful force. Over time, the real advantage of boring investments becomes visible not in dramatic milestones, but in quiet progress that compounds beneath the surface. At first, the results may feel underwhelming. The portfolio grows slowly, the fluctuations seem ordinary, and there are no exciting stories to share. But this is precisely where the strength lies. Wealth built gradually tends to be more stable, more predictable, and far less dependent on luck. One of the most overlooked benefits of a boring strategy is reduced error. Many studies in behavioral finance show that individual investors often underperform the very funds they invest in. The reason is not poor asset selection, but poor timing. They buy when markets are rising and sell when markets are falling. A disciplined, long-term approach minimizes these mistakes because it reduces the number of decisions that need to be made. Fewer decisions often mean fewer costly errors. Consider the impact of staying invested during market downturns. Markets periodically decline due to economic cycles, geopolitical events, or unexpected crises. During these moments, uncertainty feels overwhelming. However, long-term investors who remain consistent often benefit when markets recover. Historically, some of the strongest gains occur shortly after significant declines. Missing just a handful of those recovery days can materially reduce long-term returns. A boring investor who simply stays invested avoids the risk of being on the sidelines at the wrong time. Another important dimension is lifestyle flexibility. When your investment strategy is stable and low maintenance, you free yourself from constantly monitoring financial news or market movements. This reduces stress and allows you to focus on areas that truly increase your earning potential, such as career development, entrepreneurship, or acquiring valuable skills. Instead of spending energy trying to predict short-term market swings, you can concentrate on controllable factors like income growth and disciplined saving. There is also a compounding effect on confidence. As months turn into years, and years into decades, consistent contributions and steady returns begin to produce meaningful results. Watching your portfolio grow gradually builds trust in the process. This trust reduces the temptation to chase speculative opportunities. When you see firsthand how patience rewards you, the appeal of high-risk, high-volatility strategies naturally weakens. Let's look at a simplified example. Two individuals start investing at age 30. One follows a diversified, low-cost index strategy and contributes consistently every month. The other frequently shifts strategies, chasing sectors that recently performed well. After 20 years, the first investor benefits from uninterrupted compounding and lower fees. The second investor may have experienced periods of strong returns, but also periods of losses and higher transaction costs. Even if their average returns appear similar, the consistency and reduced volatility of the first approach often produce greater net wealth and lower stress. Boring investments also encourage realistic expectations. Instead of expecting to double your money quickly, you begin to appreciate gradual annual growth. For example, an average annual return of 6 to 8% may not sound exciting, but over long periods, it can multiply initial capital several times. When expectations align with realistic market behavior, you are less likely to feel disappointed or react emotionally during normal fluctuations. Importantly, this strategy builds resilience. Financial markets will always experience uncertainty. Economic cycles will continue. News headlines will amplify fear and optimism in equal measure. A boring, diversified approach does not eliminate volatility, but it creates a structure that absorbs it. Diversification spreads risk across sectors and regions, reducing dependence on any single outcome. Over time, this resilience becomes one of the most valuable features of the strategy. As the years pass, something subtle but powerful happens. The focus shifts from short-term performance to long-term trajectory. Instead of asking whether this month was good or bad, you begin to evaluate progress over 5, 10, or 15 years. That change in perspective transforms investing from a reactive activity into a disciplined system. And within that system, consistency becomes the driving force behind meaningful financial growth. At its core, the power of boring investments is not about avoiding excitement, it is about embracing sustainability. Financial markets will always offer new trends, bold predictions, and promises of rapid growth. But sustainable wealth is rarely built on excitement. It is built on structure, discipline, and time. When you align your strategy with these principles, you remove much of the uncertainty that comes from chasing outcomes you cannot control. The true strength of boring investments lies in their predictability. You do not need to forecast market cycles, identify the next breakout sector, or react to daily headlines. Instead, you commit to a diversified, low-cost approach and allow compounding to work over time. This consistency transforms investing from a stressful guessing game into a structured habit. And habits, when repeated long enough, shape outcomes in powerful ways. One practical step is to automate your investments. Set a fixed percentage of your income to be invested monthly into diversified assets. Automation removes emotion from the process and ensures that you participate in the market regardless of temporary volatility. Over years, this simple system creates momentum. Each contribution builds on the previous one, and returns begin to generate additional returns. Another important principle is maintaining realistic expectations. Markets do not move in straight lines, and even the most diversified portfolios will experience downturns. Accepting volatility as normal reduces the likelihood of panic-driven decisions. For example, a temporary 10% decline in a diversified portfolio may feel uncomfortable, but over a multi-decade horizon, such fluctuations are part of the natural growth cycle. Viewing short-term movements within a long-term framework allows you to stay focused and rational. It is also essential to understand the role of patience. Compounding requires time to reveal its full effect. In the early years, progress may appear modest. After a decade, growth becomes noticeable. After 2 or 3 decades, the results can be substantial. This timeline is not dramatic, but it is powerful. The longer you stay consistent, the more the mathematics of compounding works in your favor. Boring investments also support broader life decisions. When you are not constantly reacting to markets, you can focus on increasing your income, building valuable skills, and strengthening your financial foundation. This combination, disciplined investing and proactive income growth, accelerates progress. Instead of trying to extract extraordinary returns from the market, you create stability while expanding your earning capacity. Perhaps the most important takeaway is that wealth is often the result of ordinary actions repeated consistently. Investing monthly, keeping costs low, staying diversified, avoiding emotional reactions. These steps are simple, but their cumulative effect is significant. Over time, they create financial independence not through sudden breakthroughs, but through steady advancement. In the end, the power of boring investments lies in their reliability. They do not promise excitement, but they offer structure. They do not depend on prediction, but on participation. By committing to a disciplined, long-term strategy, you shift from chasing opportunities to building a foundation. And that foundation, built patiently, quietly, and consistently, becomes one of the strongest financial advantages you can have.